Oil prices, the West Texas Intermediate price here in the US, are up another 1.5% plus today on news that OPEC is delaying any production increases. There were a number of OPEC countries calling them quote unquote unfair, where production would be raised, because I think a lot of these OPEC countries like the higher oil price. As you can see with the chart there on the right hand side of your screen, oil prices are up a lot since November 2020. They went and consolidated for a number of months between February and April of 2021, and then they've taken off to an even higher trading range. So last week, oil prices were up because there was a higher than expected inventory draw. There was also a crude oil inventory draw the week before. So we have demand increasing and supply is being reduced here in the US. And then we have the OPEC news today, where a potential production increase in the quota was delayed because, like I said, a lot of these countries love a higher oil price. So increasing production, even if there's pressure from other countries, they want the higher oil price. They want to improve their government finances. They want to run larger trade surpluses and foreign exchange reserves. And they may even buy physical gold with those trade surpluses with the higher oil price and more foreign exchange reserves, because historically in the past, when countries that made a lot of profits in oil, they tended to recycle them, at least a portion of those profits, into physical gold. And that's actually where the Hunt brothers got a lot of their information from, why they stockpiled a lot of silver to begin with, was their oil contacts in the Middle East were stockpiling gold and silver. So the Hunt brothers, who were oil billionaires, that was one of their businesses. Obviously, they have other businesses. They used to own the Kansas City Chiefs, the American football team. I think they own a pizza chain. They owned a bunch of other businesses. They started in gold and silver because their other oil contacts all over the world were recycling oil profits in the 1970s into gold and silver, and were also worried about the dollar and inflation. So you may have that start all over again. But the bottom line here is that oil is in a higher trading range. Now, if oil continues higher, it's going to get really messy with inflation, and it's probably not going to be covered in the consumer price index. The cost of goods sold, besides just transportation costs, lots of things are made with oil or petroleum products. So that's going to also be inflationary and stagflationary. It's also going to cause a lot of shrinkflation that's not going to show up in government inflation data and the consumer price index here in the US. So as of now, we're at a substantially higher oil price, and we're going to start to see in the next month or two if that has drastically affected the profit margins of mining companies. So we haven't seen any Q2 earnings yet for any of the larger gold, silver, copper, or base metal miners yet, to see if their costs have gone up a lot. That'll be something to monitor to see how much their energy input costs have gone up, because these mining companies do not, industry-wide, historically, hedge their energy input costs. So they pay as they go because it is more expensive to pay upfront and try to lock in lower oil prices. But that's what the industry should have done at a much lower oil price. But the industry doesn't do it because the upfront capital cost is more expensive. So oil is at least going to be in a higher trading range for a while, unless we see a lot more supply come online or demand starts to drop. But as of now, I'm not seeing any signs of big supply increases. The rig count here in the US has not had a big spike yet. It is only small, privately owned, which are not publicly traded oil companies in the shale oil patch that are adding a lot of rigs. So a lot of the larger US shale oil players have not started massively increasing the rig counts back in the Permian and other areas yet. That is something to monitor. If the rig count starts to spike very, very rapidly, then an increase in oil supply will occur, and that may start to drastically affect price. But we're not seeing that. We're seeing crude inventory draws the last couple weeks. And as of now, it looks like oil is going to stay in this higher trading range, maybe go a little bit higher in the not too distant future. But if OPEC does increase production substantially, and there was analysts out there in the last couple weeks saying there was a 1.5 million per day oil production shortfall on the supply side compared to how much demand is returned. So that analysis is going around, but OPEC decided not to increase production, shocker, because they like these high prices. Now, there is a Goldilocks oil price where prices aren't too low and aren't too high, and OPEC is playing with fire. So if OPEC screws this thing up and demand increases and supply is not back online, we could see triple digit oil. If the stock market doesn't collapse, we could see triple digit oil in 6 months or less. But the higher oil prices go, the more they will act as a tax on the real economy. And that could also potentially crash stock markets, asset prices, and the real economy as well, because that started to happen in 2007 when the oil price got way above $100 a barrel. But in this environment, oil prices at 110, 120, maybe a little higher than that, could really hurt the global economy. Now, they would probably help oil companies unless governments and ESG investors put a windfall profits tax on them, but they would hurt a lot of other companies and industries with higher costs and shrinkflation and profit margin erosion that may not be able to be passed on to the customers entirely. Finally, if you like content like this and want to help keep content like this free so it doesn't all end up behind a paywall, or you want more in-depth research content, information, financial education, and analysis, there is over 170 articles now behind the paywall, including 15 new articles out in the last 6 or so weeks on a lot of in-depth topics about global macro, companies and sectors, a lot of different company and sector articles over the last couple months. It is only $5 a month to sign up for my Patreon. I think it is one of the best deals out there. I charge less than anyone in my space for premium content, and if you don't like it, you can always cancel, although I think you're really going to like it. Thank you for listening. Bottom line is that there's a lot of fundamental reasons here why the oil price has rallied substantially lately, and also why the oil price is going to be in a higher trading range now. It's tough to say if oil prices are going substantially higher in the short term, but as of right now, if OPEC does not increase oil supply and rig operators here in the U.S., the larger oil companies here in the U.S., because right now it's only small private sector, non-publicly traded companies increasing the rig count in the Permian and other shale areas here in the U.S., as long as that doesn't happen, there is no threat of enormous supply increases, at least in the short term, so over the next couple weeks, maybe the next month or two. So that should also be tailwinds for oil prices, at least staying in this trading range and maybe even going higher in the short term.